Welcome back to the deep dive. Our mission, as always, is to filter out the noise and give you the structural clarity you need for these, well, complex markets. And if you've looked at the headlines or maybe your portfolio over the past few days, you've probably felt that uncertainty. We've seen the Nasdaq fall for 4 straight days. It ended with a really sharp drop on December 17th, and the VIX, the fear gauge, it spiked almost 7%. So fear is definitely high. And the question everyone is asking is this it? Is this the beginning of the big AI collapse? Okay, let's unpack this. We've gone through the reports, we've looked at what fueled this, and we think the answer is a lot more structural than it is sensational.
That's exactly right. And that's the core takeaway we need to get to right away. For you, the long-term investor, the person trying to get some clarity here, this is not a collapse. It's not the end of the AI story. What you saw this week is simply the first major structural adjustment of the AI cycle.
That's a pretty strong claim, especially with all the selling we saw across the board. What makes you so confident that this is just an adjustment and not, the start of something worse?
It's all about where the market is applying the pressure. I mean, yes, volatility is high. The VIX is up near 18. But the market isn't really questioning if AI is valuable.
Okay.
No, it's asking two very specific questions. How is that value going to be created? And this is the critical part, at what speed and at what cost? This adjustment is healthy. It's a necessary repricing based on the financial reality of building this stuff, not a crisis based on a lack of demand. It's structure finally catching up to the sentiment.
Okay, so let's get into the facts. Walk us through the numbers for December 17th. What was the catalyst that made everyone rush for the exits at the same time?
Yeah, the numbers were rough. The Nasdaq, which is really our barometer for tech and AI, it fell 1.81%. It's fourth straight decline. The S&P 500 was down about 1.16%. And the trigger, it was squarely focused on the physical stuff, the infrastructure you need to actually power this AI revolution.
And this all centered on a big development with Oracle, right?
It did. The immediate spark was that news that Blue Owl Capital had pulled out of a massive $10 billion data center project in Michigan, a 1 gigawatt facility. And crucially, this was the facility that was reportedly going to house infrastructure for OpenAI.
Wow. So a single data center deal falls through, even a giant one like that. And Oracle, a key cloud provider, immediately drops 5%. And that fear just cascades through the chip makers. It all seems so fragile.
It is fragile, and it exposed three fundamental concerns that, investors really have to understand about this AI build-out. The fact that NVIDIA and Broadcom dropped right away just confirmed this was more than just Oracle noise. It was the market repricing risk across the entire system.
Okay, let's spend some time on those three structural issues, because that's really the why it matters part, underneath all the daily fear. What's the first concern this project collapse brought to light?
First and foremost, it's capital intensity. I mean, we're not talking about putting a few server racks in a closet anymore.
Yeah.
We're talking about building these huge 1 gigawatt scale AI data centers. And that requires just astronomical amounts of upfront capital. These are enormous real estate projects, power generation projects.
So they're incredibly vulnerable to what's happening in the credit markets.
Exactly. And that flows right into the second concern, which I'm guessing you're thinking is a return on all that money.
Precisely. The ROI.
Yep. The second concern is uncertain profitability. The market is thrilled about the potential for AI revenue, but it's now hitting the reality that, okay, you spend $10 billion to build the thing, but the timeline to get a return on that investment is hazy.
How quickly can you even fill those machines? And how fast can they generate enough money to cover the debt?
That's the billion-dollar question. And it has this historical echo that should really make investors pause. Didn't we see something like this during the dot-com bubble? All that overinvestment in fiber optic networks.
I was just thinking that. Is that parallel fair, or is that just, market trauma talking?
It's a parallel the market is definitely looking at. And while you can argue AI demand is more real than late 90s internet traffic, the financial mechanics are very similar. Companies built all this fiber assuming demand would just keep going up exponentially, but it didn't materialize fast enough. Led to some spectacular bankruptcies.
So the market is just adjusting expectations now, realizing that even with real demand, these massive costs take years, maybe longer, to pay off.
Right. It's adjusting the velocity of the cycle. And that brings us to the third most complex piece of this. The fragility of circular funding.
Okay, break that mechanism down for us. Why can one deal falling through jam up the entire system?
It's so important to get this. The AI ecosystem is basically funding itself right now in this really tight circle. You have the AI companies like the one Blue Owl was funding, spending huge amounts on infrastructure. That money flows directly to cloud providers like Oracle and especially to the chip
And
makers,
NVIDIA.
to NVIDIA. Those chip makers make enormous profits, which they and venture capital then pour back into more AI innovation, more R&D, new startups, and the cycle continues.
I see. So the fragility comes in if that initial capital injection, if the funding for the data centers themselves dries up.
The whole thing slows down. If Oracle loses a $10 billion project, the market assumes less revenue for NVIDIA down the road. That means maybe less capital for the next wave of AI startups, which means less future demand for compute. It's all linked. And that Oracle news showed the market just how sensitive that first step, the capital input, really is.
That perfectly explains the violent reaction. It wasn't just about Oracle, it was about the risk in that whole circular structure being confirmed. Now let's zoom out. That gives us perfect clarity on the fear around AI stocks. But they don't exist in a vacuum. We have to look at what the Fed is signaling because all this is happening in a very confusing macro environment. And this is where it gets really interesting.
Absolutely. You have to bring in Fed Governor Waller's comments from the Yale CEO Summit. They were so important for setting the stage here. Waller suggested the Fed has room for maybe 50 to 100 basis points of rate cuts, just to get back to what they call the neutral rate.
But the key part, the part that often gets missed, was when he said, no need to rush.
That phrase is everything. You have to understand, he's talking about normalization cuts. This is the Fed slowly lowering rates back to normal because inflation is cooling off and growth is slowing down, but in a good way. It's how you engineer a soft landing.
And that's totally different from what the market sometimes fears, which is emergency easing.
Exactly. Emergency easing is when the Fed is slashing rates because the economy is already in a crisis or about to fall off a cliff. Waller's gradual approach says things are slowing, but they're not collapsing.
And the slow approach is because the economic data is just all over the place right
It's
now.
extremely mixed, and that's what's fueling a lot of the volatility.
So walk us through that. What are the conflicting signals that have the Fed on this tightrope?
Well, on one hand, the unemployment rate is creeping up. It hit a 4-year high. That's a clear sign the labor market is softening, and that's a worry.
But on the other hand,
Non-farm payrolls still came in better than expected. So hiring is slowing, sure, but it's still resilient. And then you look at the forward-looking stuff. The PMIs for manufacturing and services were both below expectations. That confirms the high cost of money is finally starting to bite to cool things down.
so the data is basically inconclusive. It screams slowing, but not collapse, which just creates more uncertainty day to day.
It does, and that's why we have to stop looking at the daily news and start focusing on the real signals over the next, say, 1 to 6 months.
All right, what should we be watching? What are those future signals?
There are 3 big ones. First, we need validation from earnings. And tonight's report from Micron Technology is absolutely crucial.
Why Micron specifically?
Because Micron validates the story around high bandwidth memory, HBM chips. These are absolutely essential for high-end AI processors from NVIDIA. HBM is what lets them stack memory right on the processor. It massively increases bandwidth, cuts down on latency, all things you absolutely need for these huge AI workloads.
Okay, so if Micron comes out with strong guidance, it suggests the real physical demand for the guts of AI is still strong despite the market jitters. It confirms the cycle is adjusting, not collapsing.
Exactly. The second signal is tomorrow's CPI print, the inflation number.
Right.
And you have to see this as a volatility trigger, not a trend changer. If that number comes in surprisingly hot, yes, the market will get turbulent. It will question the Fed's gradual path, and that means near-term pain.
And the last signal, we circle back to the VIX. It's around 17.62. What are the levels we need to watch there?
The VIX tells you about positioning. Yeah. Right now, 17.62 means caution is priced in. The first critical level is 20. If we break above 20 and stay there, that signals a serious short-term adjustment is happening.
And on the downside?
If it settles back below 15, that tells you the market is getting comfortable again with valuations and the Fed's path. So watch 20 and 15.
This synthesis of AI risk and Fed policy brings us to the big question for our listener. So what does this all mean for my portfolio?
And the strategy has to be different depending on your time horizon. You have to apply strategy based on that, not on the daily price swings.
Okay, let's start with the long-term investor, the 5+ year horizon, looking past all this noise. What's the advice?
For you, this adjustment is a gift. It's a temporary sale on high-quality growth. The key here is patience and staged accumulation. Think dollar-cost averaging. Use this pullback in the high-quality names, your NVIDIAs, your Microsofts, as buying opportunities.
Well, not all at once.
Absolutely not. The discipline is crucial. Spread your buys out over the next 3 to 6 months. You want to capture the average price through this volatility. Set a schedule and just stick to it.
And what about managing risk inside the portfolio?
Take a hard look at your sector concentration right now. After this huge AI run, a lot of people probably have over 60% of their portfolio in tech. If that's you, it's time to rebalance structurally. Look at adding to defensives, healthcare, utilities, high-quality dividend pairs. They provide that ballast when growth stocks get shaky.
Now, what about the medium-term investor, the 1 to 3 year person who has to be more nimble?
That group needs to be cautious but opportunistic. The most important thing for you is to maintain a strong cash buffer. We'd say 10 to 20% of your portfolio
For optionality.
for optionality. That cash lets you step in and act when you see a real bottoming signal, not just watch from the sidelines.
And what does a bottoming signal look like technically?
You'd be watching for things like the RSI dipping way into oversold territory,
Mm-hmm.
or, more concretely, a really firm bounce off a major support level, like the 200-day moving average. Or maybe the S&P 500 test, say 6,500, and then recover sharply. You have to be ready to use that cash.
This is great guidance. So let's bring it all together for a final takeaway. The AI revolution is real, but the cost of building it is causing a shakeout. What are the key principles to hold on to?
The number one principle is quality selection. The capital needed here is so huge that not all AI companies will be winners.
Yeah.
You have to focus on quality, clean balance sheets, and a clear path to actually making money. The market wants proof now, not just promises. Second, the Fed is signaling policy normalization, not panic. That's a sign of long-term health. The gradual approach is structurally good for stocks, even if the mixed data causes short-term chaos.
And finally,
Diversification is your anchor. Always. Look at gold. It was up almost 1% on the day tech got routed. That's a classic risk-off barometer. Having those defensive non-correlated assets is critical.
that clarity is essential. But before we close, there was one other risk factor in the source material that goes beyond economics or AI, and that's the layer of political uncertainty that's starting to build.
That's a really crucial point to keep on the radar as a future structural risk. We saw that Fed Governor Waller is apparently going to be interviewed by former President Trump as a potential candidate for the 2026 Fed chair job.
And while that isn't affecting markets today, why is that a structural risk we need to think about?
It means that you, the listener, have to start considering that the Fed's future leadership, and therefore the path of monetary policy after 2025, could be heavily influenced by the next election. That political factor adds a whole other layer of complexity to the medium-term outlook. It's completely separate from economics or AI fundamentals. And that dynamic is going to be the next big structural risk to navigate.
A really thought-provoking point to keep in mind. So you have the structural risks in AI combined with this political uncertainty that's really going to define the landscape for the next few years.
Discipline, time horizon, and a relentless focus on quality over headlines. Those are the tools you need for this next phase.
Thank you for bringing that essential clarity to all this turbulence. If you want calm, structural market insight, not the screaming headlines, stay with us as we continue to deep dive through the next phases of this cycle. We'll be back tomorrow with the full analysis of that critical CPI report. Until then, keep learning and stay disciplined.